Hello and welcome back to Market Shares. I'm your host, Tony Blodgett, and today I have a fantastic guest with me today. You guys know that I love to geek out a little bit on, capital markets and what's going on with the mortgage interest rates and so on and so forth. But, I would say that, I'm like an armchair quarterback compared to our guest today. I like to, learn about this stuff as much as I can, but I'm really more on the sales side of the mortgage industry. I think it's important for all of us, though, to have knowledge of what goes on in capital markets and secondary. And so I invited on our Chief Investment Officer here at New American Funding, Jason Obradovich. Jason, welcome to Market Shares.
Tony, thanks so much. Thanks for having me.
Yeah, well, I think this is going to be fun. I mean, it might be a little deep for some people, but hey, we don't mind getting a little technical here on Market Shares once in a while. Jason, you and I have worked together for now almost 11 and a half years. I would say there's a real unique partnership at our company between, the sales leadership and capital markets. We have meetings literally every week. We talk about what's going on in the market, what are the right strategies that we want to bring to market. But I want to get a little more technical today, and just some of the things that are on my mind that I think are probably on our audience's mind as well. Before we jump into kind of my list of questions, maybe just give us a quick background on who you are and how long you've been in the mortgage business, kind of what's your journey that led you to New American. How long you been? I don't even know how long you've been here. Longer than me because you were here when I got here. So
Yeah, happy to do so. I've been in the industry. I started the industry in '96. So I've been in the industry. This is my 30th year. Can't believe it. It's gone actually pretty quick. So I was there for the dot-com, boom bust. I was there for the financial crisis, kind of at ground zero at Countrywide. I worked in the credit union industry for a while. Didn't necessarily enjoy that as much as working for an IMB, and then found Rick and Patty here at New American in 2013. I actually started, and then 2 days later was Bernanke doing the taper comment, and that just sent yields flying. So literally the day after I start, he makes that comment, yields go through the roof, volume shuts off. It was not the most fun intro to New American Funding, but it's been a great journey. Love the company, want to be here forever. Love meeting you and some of the other leaders within NAF. So I've had a great career, always in capital markets or some type of capital markets like role. And it's just something I've always really enjoyed.
was that the taper tantrum, as they call it? Everyone
Yeah.
freaked out when he said that. Yeah, I remember that.
Yeah.
I remember that. Well, I started in '97, so you got a little bit of time on me, but not a lot, Jason, not a lot. All right, well, I'm getting you totally out of your comfort zone because you do a pretty regular market update, but I think you limit them to about 90 seconds to 2 minutes. And so this long form conversation, I'm sure is gonna get you out of your comfort zone a little bit. So I appreciate you doing that. But I watched your most recent market rundown that you put out on a pretty regular basis, and let's just talk about that update because it was the most recent one. And I want to see if your thoughts are still the same. We were right in the middle of the government shutdown when you put that out, and the Fed had just cut interest rates, but we weren't getting employment data. We weren't getting a lot of other information that we needed. And but one thing that the Fed did bring up, that I almost said Bernanke. The thing that Jerome Powell did bring up was that they were going to pause quantitative tightening, which I think is a very positive thing for mortgage rates, but it might also mean that there's less, buyer of mortgage-backed securities, or reinvesting, if you will, in the runoff. So maybe clarify in your words, what does that mean when they pause the QT? Is that a good thing for us? And is there risk to interest rates as a result of that shift in their policy?
Yeah, I would say, just taking a quick step back, we don't necessarily want the US government buying and selling treasuries, buying and selling mortgage-backed securities, and kind of exerting their influence on the market. Now, post-financial crisis, that's when this all started. And they had Operation Twist, QE1, QE2, QE3. We've had so many of these QEs, and being a mortgage banker and a homeowner, it's been fantastic, right? They've brought rates down. It's been a fantastic thing. The flip side of it, which we've been painfully dealing with, is when the government exits something like that, QE I can't remember the last number for, finishes, and we get into 2022, inflation starts, spiking, and now the Fed's looking, going, we might have an asset bubble somewhere. So, hey, not only are we not going to buy assets, we're now going to be a seller of assets. So not only are we not supporting a market, we're actually penalizing a market. And so when you look at the pause in QT, to me, I look at it as more of a neutral stance. You're not helping the market. You're not hurting the market. You're kind of acting as if you don't exist. I think it's somewhat supportive, to be honest, because part of QT was just the natural runoff of MBS, right? Loans pay off and you're going to have that natural runoff. And so they're kind of pausing that piece of it. So I think it's somewhat supportive. Now, I think we were talking earlier before we got on the call about mortgage-backed spreads coming in a little bit, and that did help. So I do think it is supportive, but it's very minor.
Yeah. Okay. So I get what you're saying, which is like kind of stay out of it, right? The Fed should kind of stay out of it. They've been really involved. They tried to unwind that position. That is not necessarily helpful for us, but for them to stop, letting that balance sheet run off, which would, I guess, cause more supply into the market. They stopped letting those run off, right? So it should help the supply demand balance out a little bit. So should be helpful.
Yeah, it's slightly helpful. Like I said, I prefer them not be involved unless they have to be. And it's, they're not really in a position where they have to be. So it's kind of like, I hate to say, like, stay out.
Yeah. Well, and I think that Jerome Powell, based on his comments, like, I don't see a situation where they would be a net buyer of mortgage-backed securities in the future. I think that was kind of unprecedented, the amount that they purchased during COVID. I think we could argue they probably drove rates even lower than they needed to try to help deal with the situation. And now they've been trying to kind of get themselves out of it a little bit. But if I feel like that's kind of off the table in the future, unless there's some crazy catastrophic thing, but probably not. A lot of people said, well, if the Fed could just start buying MBS again, it would help out interest rates. I don't see that happening. Are you in that camp as well?
Yeah, I don't think the mortgage market's in a position where we need them to. So I don't think they sense the urgency. And so I just don't think they're going to have an involvement. I think QT is a nice way of saying, hey, look, we don't want the housing market to get worse, right? There's been inflation, interest rates were rising. Like, we all dealt with what we saw over the last 3 years. And we certainly wouldn't want illiquidity in the market, or just, let's say, another inflation spike really disrupt, all of mortgage lending. So we're going to take a stance to let everyone know we're going to be neutral, but we are standing here just in case.
Yeah. So the other thing you mentioned in your rundown is, the Fed just cut for their second time in a row, 25 basis points. And now we're coming to the end of the year, right? We have the December Fed meeting, and it seemed like there was still a high probability that they were going to do a cut. I've heard now, since the jobs numbers finally came out after the shutdown ended, we got some jobs numbers, and they were a little bit stronger than people expected. I think those were September's numbers. I don't believe we have October's numbers yet, and they'll probably come out when we get the November numbers, is my understanding. So where are you at today with a December rate cut? What are your thoughts on that?
Yeah, if you ask the market, it's really bounced around. We went from virtual certainty, basically 100% priced in, to, what was it, 2 days ago, 3 days ago, it was only a 34% chance of a December rate cut. And then today, if I look at the futures contract, it's actually at 82% priced in. So I think the market's accepting the fact that it's probably going to happen in December.
Wow. So we went from just a 30% chance a couple days ago to 80% chance as we record this here today.
Yeah. You had some of the retail sales data, you had the ADP employment data. We've also had data being delayed due to the government shutdown. So you've had a lot of different things, and the market was blind, kind of operating blind. So what did they do? They listened to the Federal Reserve members, and a couple came out saying, I don't think December is on the table. And the market panicked and said, hey, maybe there isn't one in December. And then you get a couple days later, you look at, the ADP report saying, job growth really isn't there. And a couple other reserve members say, hey, I think we have to do December, and now we just swing the other way. So we're getting these big pendulum slings, a lot of it due to the government, shutdown and the lack of data out there.
Interesting. You were sharing with me before we came on here live that there is some futures data that kind of shows what is predicted as far as these Fed rate cuts. Would you mind bringing that up and kind of talking us through what the market has priced in? Because I think this is something that people forget about, is that the market's already kind of decided what it thinks is going to happen. And oftentimes rates are already reflective of what you see here in the futures numbers. And then that's part of the reason why sometimes when the Fed acts, if he doesn't do what's expected, even though it seems like it should be a good thing for interest rates, if the market was thinking something different was going to happen, it can have a very positive and or negative impact. So let's look at what the market's predicting as we sit here today.
Yeah. Yeah. So when you hear me say things like 80% priced in, there's real data and there's futures contracts that's traded based on that. So if I were to go into a system like Bloomberg and look at the current futures contracts for future Federal Reserve Board meetings and what those implied interest rate futures say, we can actually do the calculation. And thankfully, a tool like Bloomberg does the calculation for us. So what I can look at is, all right, our effective Fed funds rate today is 388. If I go to the December 10th meeting, it's letting me know that that contract is priced at 367, an implied rate reduction of 21 basis points or 20 and a half basis points. Well, that would imply that it's an 82% chance of a Fed interest rate cut of 25 basis points. And that's how you get the probabilities that I just stated to you. And you actually can go out into the future and look and say, okay, what about December of 2026? What's the market telling us? So if I go to the 12/9 meeting in 2026, it's implying that the Fed funds rate is going to be 94 basis points lower than today. So what is that? That is almost, 2.9%. So that's how much is priced in. So a lot of times you'll hear LOs, you'll hear news articles say, hey, the Fed just lowered rates, and then LOs will scratch their head going, the Fed just lowered rates. Why aren't mortgage rates getting better? Why are they potentially getting worse? And it all has to do with it's already priced in. So what's the market now expecting future changes are going to be versus what's already priced in?
Oh, yeah, that makes sense. I don't think I've ever seen it illustrated that way, Jason. That's very helpful. I appreciate you pulling that up.
Yep.
All right. So at this point, we're a day or two before Thanksgiving as we're recording this. We'll definitely get this episode out before the Fed rate cut. But, those numbers might have changed a little bit, but just know that they're changing every single day. But as we sit here right before Thanksgiving, looks like 80% chance of a Fed rate cut in December. So let's see if that plays out. Okay. So let's talk about the government shutdown. It went on for a long time. It's over. I mean, in my mind, it's over. We've moved on. But is there, long-term impacts, do you think, of the government shutdown? Is there anything you could think of with that government shutdown that's going to have an impact on either, equities markets, bond market, our markets in general now that this is over? Or is it kind of one of these things where, hey, we've solved it, at least for now, it sounds like, and things should kind of go back to normal?
Yeah, I would judge this shutdown as something as kind of going back to normal, although it was a very long shutdown. If you looked at the pain point, it was around this continuing resolution, basically like, hey, we've decided we're going to spend this amount and we're going to spend this amount. And so the shutdown was just kind of the semantics of that. There's a lot of posturing from both sides. I won't pick sides, but really from an economic standpoint is, okay, the government got refunded. The money that was expected to be spent is now spent. So that money is now in circulation. So it's not like it's caused harm. There's no artificial kind of benefit to the economy. There's no artificial harm come, from the shutdown. So it's just back to business as usual. It's just a market disruption.
Cool. All right. Well, that makes a lot of sense. All right. I have a topic that I think is just, I don't know, it's fascinating to me, something that I'm really focused on in 2026, which is non-QM, right? Non-qualified mortgages. And I think that there's definitely a segment of the mortgage market who is really up to speed on non-QM. And we see a lot of loan officers that are benefiting and growing their business because of their understanding and aptitude around these products and programs. And I think a lot of people are missing the boat right now as far as non-QM. And you ask a lot of loan officers, what non-QM options are available, or what percentage of your pipeline is non-QM right now. And some people aren't even tapping into that market. So that's for loan officers to get educated on, but I want to get your take on a few things. First of all, just non-QM in general. I know we call it non-QM because we had the QM rule, and these are loans that are outside of the QM rule. They still have ATR requirements, ability to repay, but they don't meet the qualified mortgage kind of exemption. But it feels a lot like this is very similar to how we started the run up to the last meltdown, if I'm being honest with you, right? It started with kind of like, these alt A products. We got into subprime products. All these things were kind of alternative to agency or conventional standard government financing. I mean, it kind of feels like the same thing all over again, but now we have ATR involved. So I don't know. What is your take on the non-QM market? Do you see it continuing to grow? And by grow, I don't just mean as far as the percentage of market share, but as far as the diversity of product that's available in the non-QM space. Do you see the appetite growing by institutional investors and Wall Street eventually and whatnot? Just your overall take on kind of where non-QM's at today, where it's going, and are we just starting another ascent into craziness as far as high risk mortgage products go?
Yeah, I'll try to give you a short answer. I think from my standpoint, like being in the capital markets world, when you think of product, there's thinking of the borrower and then there's thinking of the investor. So spending an entire career in capital markets, I think about from the investor standpoint, it's an asset they're investing in. And then, oh, by the way, I hope there are borrowers that actually fit it, and it's bringing the two together. So when I think non-QM, yeah, obviously you mentioned kind of the shades of, prior to the financial crisis. I do think ATR is probably one of the most important features that make non-QM very different than what happened pre-crisis. But from an investment standpoint, there is a ton of demand for this product. Now, it's not that investors want non-QM. They're not going out saying, I want to buy non-QM. What they're looking for is, I want a certain yield and a certain performance. And non-QM really meets both of those things. And what that means is they want higher yield. When you buy MBSs, you don't get great yield. Now you get great credit because it's guaranteed by the government, Fannie, Freddie, Ginnie, whatever, GSE controlled. But you also get liquidity, which means you have mortgage-backed securities that are very transportable. They can be traded on, open exchanges. It's very different than non-QM, where you have to buy them in whole loan form. And because you're buying in whole loan form, you get more yield. So the investor is getting more yield. It's good credit. It passes ATR. It's usually lower LTV, higher FICO. You just have to get used to that. There's a story behind the income documentation or something about the loan, why it doesn't meet agency or government guidelines. And so a lot of times they'll just call it a story pool or a story loan because you have to tell the story behind it. But there's a lot of yield there with good credit. And so I see a lot of investors want yield. Think about for yourself for a second. Let's say you bought an agency MBS and it's earning a 5% yield. Well, let's say the Fed lowers rates tomorrow. Every single one of those borrowers could refinance, right? And so this asset that you bought could completely pay off. Well, the story behind non-QM is it's harder for them to qualify. There aren't as many options for them as far as lenders. There's not streamlined programs for them where they can, refi, rapidly and for multiple times. And so there's just less options. And so they don't refi or pay off as quickly. So this asset you bought is likely to last longer. And so you get the higher yield and for potentially a longer period of time.
Oh yeah, that does make a lot of sense. So if a loan officer is thinking like, hey, I don't want to put my time into learning this product because I've seen little windows of time over even the last few years where this market kind of shrank up like really quick. The market got nervous for whatever reason, something was going on, and, non-QM kind of dried up for a minute. Do you think there's a risk of that happening again? It sounds like maybe not. It sounds like there's a pretty high demand for this type of an investment vehicle, so what are your thoughts on this? Is this something that's here for the long run, and should loan officers spend the time to get educated on these products?
I think liquidity, to address that part of it, liquidity is a waterfall. Like treasuries are probably the most liquid. MBS would be behind that. Whole loans would be behind that. deep distressed credit would be much further behind that. So if you have a liquidity event where maybe treasuries aren't necessarily trading as well, like that's going to waterfall down. If MBSs aren't trading as well, that's going to waterfall down. So there's always the risk of non-QM of liquidity temporarily being disrupted. COVID was, an example. That was a very extreme example. If there's a credit crisis, that would be a more extreme example. But aside from that, there's been a very constant supply of demand outside of credit events or major liquidity scenarios like we had with COVID.
Okay. Okay. And it seems like there's some pretty solid buyers of these securities, right? You had mentioned to me before in a previous conversation about insurance companies and how much they like to invest in these non-QM products, but their credit box might be a little bit tighter. So is there less appetite then for the higher risk non-QM type products than there is for the stuff that's, that lower FICO, lower LTV, higher FICO, maybe a better story around how income was looked at versus the higher risk? And I guess what I'm getting at here is there less of an appetite, do you feel right now, that would lead us towards what would be considered by many people subprime kind of products, because the bulk of the demand is in the higher credit quality, lower loan to value kind of segment of the non-QM space?
Yeah, I'll try to give you another quick answer. So if we pool an agency or government loan, it goes into an MBS, and that is very plain vanilla MBS, and there's a lot of liquidity. And it's based on GSE guidelines. It's very simple structure. When you go to something like non-QM seconds, anything that's not going to those agency MBSs, now every individual investor may have a different bid, a different price, different credit guidelines, different sensitivities. And so when you're someone in capital markets like myself and selling these loans, like you have to match the price with the guidelines, and that is a more difficult but meaningful exercise because not everyone's looking at them the exact same way. One investor may say, I only want 740 FICO. Another investor say, I only want certain states. Another investor say, I only want investment properties. Like everyone has different demand. And so you have to figure out how to kind of segment a population that an originator would have into all those different demands to really get either the best guides or the best pricing or some combination. So when you think of a crisis like 2008 and what happened during subprime, it was a very different dynamic. These were not whole loans going to individual buyers, and they were taking on all this credit and known credit. What was happening is there was so much volume and so much liquidity, and you had the rating agencies rating deals with high ratings saying, hey, this is a AAA security. And a person who's trying to buy a AAA rated security, the highest level of credit on a security, and it's not AAA, it turns out it's not AAA, then yeah, they were investing something that they weren't investing in. It's not like they were buying loans, they were buying securities. If you've seen in the movies, related to the crisis, they probably do a better job than I describing kind of the repooling of credit and to get a higher rating. And so that caused a problem. We are nowhere near that. We don't have that kind of liquidity. We don't have the rating issues kind of with their eye off the ball. Like we're just not in that world anymore.
Can you speak at all to what created that much liquidity and demand for those products and why we won't see that again? Or do you think there is a possibility we see that again in a future state of the market? Like, what is the difference? Why there was so much liquidity available to buy these up, and why that it's so limited to individual kind of investors at this point?
Yeah, I'll try to make this quick as well. Personal belief. This is a personal belief, right? People have written books, essays, and there's been movies around the financial crisis. To me, there was two major issues with the financial crisis. Number one is the rating agencies just did not model the performance of limited or no doc loans, especially at higher LTVs with seconds behind them. It wasn't modeled right. So the security ratings that people were buying, the rating agencies, like when you buy AAA or triple B, they weren't. They might have been single B or double B. They were not AAA. So that was flaw number one. Flaw number two, if you think about no doc loans, let's just use that as an example. Why would a lender give a no doc loan? It's like if you don't like credit, you're probably not going to lend there. What I really believe is that we had excessive supply of housing. We had too many houses and not enough buyers. Well, the only way you could solve that is you have to qualify people for houses that may not otherwise would have qualified. So to me, we just had too many houses. That does not exist today. We have the opposite problem, right? But that was a contributing factor. I still think a material contributing factor. So you combine too many houses with the rating agencies that not necessarily know how to assess risk, and you kind of get the perfect storm of, problems that we had.
Got it. Okay. Well, hey, this is super helpful. I'm sorry, we go into kind of geek out mode here, but I think this is important stuff, even for loan officers to at least, try to wrap their head around and understand this market because, this is a big segment and a growing segment of the mortgages that we originate. And I think that our customers have questions about them. I think that our realtors have questions about these products. And the more you learn about, how they work, what they are, where that part of the market is going, I think the better off you're going to be as an originator. I expect to see, as much as 30% of mortgages originated in 2026 to be, maybe not quite that high. Do you know the estimate for what percentage is going to be non-QM? I know it's growing substantially. I don't know if it's quite as high as 30%. I think it might be in the 20s.
Yeah, I don't know the official number, but I would think 20s feels about the right number.
Yeah, because a couple of years ago it was 5%. So I mean, we're talking about a pretty significant, segment of growth here within the market. So all right, let's pivot a little bit now that our brains are all kind of cracked a little bit. Let's just talk a little bit about something that we've been watching very closely. I've talked about it on this podcast, and it's the spread between the 10-year and mortgage interest rates. And I know that you have some charts on this because you've shared them with me before. And I just want to take a look at this because a lot of thought is that we need the 10-year, at the time we're recording this, I believe today it's under 4 again. And you probably have it right there in front of you on where it's at. But I believe the 10-year dipped under 4. Interest rates have definitely improved a little bit over the last few weeks. But I think there's still some thought that we're going to continue to see some compression between the 10-year and mortgage rates. So if we see the 10-year come down, we should also see this spread between them come down and get back to historic levels. I'd love to look at kind of pre-COVID historic levels of that spread, kind of what happened during COVID, and then how close are we to getting back to what would be considered a more normal spread there between the 10-year and mortgage rates.
Yeah, I'll try the best I can to summarize. I do have the access to Bloomberg, so I'll share my screen where I can show you historically, like you asked, what's a normal spread? What does the spread even mean? So let me start with what the spread means, right? If you're buying a mortgage-backed security, what I'm going to show you is basically the yield on a mortgage-backed security, not a mortgage rate that a borrower would get, but really the yield of the mortgage-backed security, and compare that to a yield on a Treasury bond. Now, in the old days, the 10-year was kind of, thought to be the right term to compare to mortgages. Average mortgage lasts 10 years. Let's compare it to a 10-year Treasury. Well, the average mortgage probably doesn't last 10 years anymore, but I still think it's a good comparison because the 10-year is probably the most traded Treasury and the most kind of broadcast Treasury yield that's out there. And yeah, it did touch the 3.997 today. Fantastic. We're under 4%. So yeah, let me share my screen. I will show you what it means. So let's not focus on the upper graph because that's really just graphing the yield on mortgage-backed securities in the white and the yield on the 10-year in the orange. This is the spread between the two of them. So if we look in 2019, we can see the spread's about 70 to 80 basis points. That's 0.8% difference in yield. So if the 10-year was 4, mortgage-backed securities yield would be 4.8%. And when you got to COVID, I think we all remember March of 2020 and where we were, that spread when liquidity dried up, just went the other direction, right? Mortgages traded terrible. There was no liquidity. The Fed had to step in and start buying mortgage-backed securities to support, a potential housing crash. And then what happened is we had QE. The Fed started gobbling up mortgages. Yields went down on the 10-year. Yields went down on the mortgage-backed securities, and that spread got as low as 20. We've never seen anything like that in the history of our lives. We saw it once. And so I know you alluded earlier to maybe the Fed bought too much MBS. Yeah, I think we all can agree. The Fed probably bought too much MBS. They probably drove mortgage yields down too much. But hey, you know what? As a pandemic, stuff happens. Then what's happened is we've seen the Fed basically starting to slow down their buying. They started tapering their asset purchase, kind of like the Bernanke comment, but tapering their asset purchases. And at the same time, we also saw inflation spiking. So we just saw the run up of yields, for 2 solid years where it started reaching levels that we don't really see very often either. And so we actually kind of got the other end of the pendulum swing. And then really since that time, we've come back in and leveled off. This year has been much better. The year has finished, and you can see kind of for the balance of the year, what is this? From September to today, we're right around 100, which I would say is more normal like. I still think it has room to come down. Just so long as we don't have an inflation spike or the Fed doesn't do something and restarts QT.
Okay, so we've gotten the bulk of that, compression happening from where we were, what was that, 2022, 2023, it looks like middle of 23, where it was kind of up there pretty high. So they've come down a lot. So you would see that in the rates today, but maybe another 20, 25 basis points of consolidation there to get that spread back to what we can maybe consider normal. So that's good. So, I mean, if you look at the 10-year rates as your benchmark for kind of what mortgage rates are doing, we should see, not that there's a more direct correlation, but if the 10-year comes down and that spread shrinks a little bit, we could see, all of that improvement kind of going into mortgage rates as we move into next year.
Yeah, I remember early in my career, people used to say there was always about a 200 basis point spread between the 10-year and the mortgage rate the borrower would see. And I think that spread is kind of typically what people would quote. And so sometimes you would quote, hey, we're higher than that, we're lower than that. Comparing to the 10-year, I don't want to get overly technical because I think it would be an entire new podcast on how mortgage-backed securities trade and how buyers don't look at just the 10-year, they look at the entire curve. I don't want to go down that road, but really, I think for simplicity's sake, like you should assume about 100 bips spread between MBSs and the 10-year and a 200 spread between the 10-year and the actual mortgage rate a borrower would get.
Okay. And we're probably a little bit above that right now. Is that what you would say? And it should be getting back to that 200 number?
Yeah, we're closer. Like, I don't want to introduce like, hey, in 2023, the yield curve was also inverted, which also pushes the spread up. We have a more steeper yield curve. It could steepen out again. It could invert again. Like that messes with the spread. There's just so many other dynamics, but just in a more normal market, the spreads I just talked about is probably a fair representation.
Okay, perfect. All right. So I'm just curious, Jason, like from your seat as, you're the chief investment officer, but you oversee capital markets and secondary. What are the things that, you worry about, as you sit in your chair doing your day-to-day job? We all have things that are like, okay, worst case scenario today, this is going to happen. I'm just kind of curious more than anything, like what are the risks for a guy like you? What are the things that you have to keep your eye on the ball of? And, things that you would say, hey, if this happened, it'd be a challenging day.
Yeah, I think just the nature of working in capital markets, you're always thinking of kind of worst case scenario this direction and worst case scenario that direction. And so, I actually talk with, Rick, our owner, a lot about, hey, what's the worst thing to happen tomorrow? What's the worst thing to happen next month? And what's the worst thing to happen next year? You start thinking about rates up versus rates down. And so in the rates up example, it would be another inflation spike, right? That could be very devastating to mortgage-backed securities, to rates. If the Fed suddenly doesn't step in and support MBSs, that spread from 100 could go back out to 200, right? It could be really devastating at a time where we're saying, hey, the housing market's probably starting to level off. Insurance is getting expensive. Payments are already high with high prices and higher than what we're used to over the last 5 years in terms of rates. Like that would probably be the bad. So an inflation spike in my mind would be that's bad because now the Fed's going to say, not only we're not going to lower rates, we might raise rates, and that Fed fund futures grid I showed you and what was priced in next year swings the other direction, and that all suddenly gets priced in. So that would be one direction. The other direction is now the economy is really slowing down. Maybe, the unemployment rate starts spiking. There's job losses. Yeah, we're mortgage bankers and we like lower rates, but now you have the economy suffering. Now, does the economy suffering if it were anything material? Now, remember, I'm talking about very extreme moves, not what I think is going to happen, but the more extreme. But let's just say the economy starts backing up. We're starting to go into recession. Now you hear credit fears. Yeah, rates are going down, but maybe credit suddenly becomes a challenge where investors are saying, hey, I don't want 95 LTVs, or I don't want 90 LTVs, or I don't want 640 FICOs. Like now those whole loans we talked about maybe don't trade necessarily as well. So yeah, as a mortgage banker, it's probably better rates are going down when the economy's slowing down. But when we talk extremes, you wouldn't want you wouldn't want a recession.
Yeah, yeah. It just makes it really causes liquidity issues, right? Is that the biggest challenge? Is people's appetite shrinks, and we want to offer as many options to our borrowers and give loan officers as access to as many products as possible. And when the secondary market doesn't have an appetite for those things, it puts us in a very risky situation, stuck in the middle.
Yeah, to be honest, like as mortgage bankers, we just experienced the extreme of the two things I just talked about. In March of 2020, we saw huge recessionary concerns, huge, recessionary fears. We saw deflation and we saw the Fed stepping in and rates came flying down. And then 2.5 years later, we saw inflation spike and the other side of it where rates just went skyrocketing higher. Like we already got both. So to me, it's like anything that happens over the next year is going to be a fraction of what we just saw.
It's a cakewalk at this point. Well, I got to give you a ton of credit during that whole COVID thing, man. We were on calls almost daily. I'm sure anybody in leadership in the mortgage industry was. But you know what? We didn't shut off a bunch of products. We didn't shut off a bunch of programs. We didn't stop doing, a lot of our FHA loans that, we pride ourselves in doing what some people would consider higher risk loans. We saw people shutting those things off completely. Nothing under, 640 FICO or even 700 with some investors. A lot of people stopped doing their jumbo lending, and man, you kept us, in the game during all that. And I gained a lot of respect for you with how we handled COVID, mostly because although I don't know what you do every day in and out, but I see what the impact is compared to what I saw other companies and other leaders going through. And I felt very fortunate to have you at the helm, taking us through that craziness, because it made a big difference. I think it really did.
Oh, thank you, Tony. I really appreciate that. I think the goal for our capital markets is always to be not to expect something like to happen, to be ready if it does. And we were ready.
Yeah.
And we're very thankful that we were ready. We were lined up the way we need to be lined up, and glad obviously the entire economy made its way through COVID, but very happy with the way NAF was able to navigate and not have any disruptions whatsoever.
Yeah, no, absolutely. Well, okay, we're going to wrap up here. I'm going to put you on the spot a little bit because I intend to have you back. I think that there is a segment of my audience who loves these types of conversations, just like me. And there's some people who probably tuned out after 2 minutes going, I don't know even what capital market stands for. And that's fine. That's fine. I'm going to cater to the people that are the mortgage geeks like myself. But I'm going to put you on the spot a little bit and just ask you what you think interest rates are going to do in 2026. As we come here to the end of the year, there's like 3 years in a row here of thinking that we're going to see rate relief. We're going to see, a refinance cycle. All these people that are, married their house and they're dating their rate. They think that they can now get married to their rate. Is all that going to happen in 2026, or what is your prediction for 2026 as far as what are interest rates going to do?
Yeah, I think 6 months ago, I would probably give you a different answer. 6 months ago, when the government was looking at some of the DOGE efforts and really cutting back on spending, I thought, boy, that's really going to pull back on the economy. That's really going to make inflation just halt, and we're going to see lower rates as a result. And, unfortunately, I think there was some savings, although I don't know if anyone knows the exact amount. I think there's some estimates on savings. The spending is still going on. And so for me, it's like, hey, as long as the government keeps increasing the national debt and continues to spend money, the economy is doing well, there's still always that slight upward pressure on inflation, which is really not going to allow inflation to be at levels which I think I would be more comfortable knowing that, hey, I can state with confidence rates are coming down. I think as long as you hear the Federal Reserve continue to say we are still concerned about inflation, then I don't see that necessarily happening quickly. So I think what I showed in terms of the interest rate probabilities due to the Fed fund futures, I think is probably the most accurate. And I would stand behind that. Hey, we're probably going to get a move in December. We're probably going to get 3 drops next year. Obviously, no one can predict the future. Maybe we'll get lucky if we have 4, but I'm a 3 to 4 next year is probably the most likely.
So if we see 100 basis point improvement in the Fed funds rate, how much of that translates into mortgage rates? I mean, it's not 1-to-1, is it?
Yeah, I mean, the market's pricing in 3 already. So if we get 4, yeah, I think the rates will come down another quarter, maybe more. But you remember, you're already priced in 3. So it's not like they dropped 3. It's like, well, that already happened. Well, that's priced in. So I do think you're going to see mortgages more often than not in the 5s in 2026 than you will see in the 6s. I don't think the 4s are really possible. You'd have to have a recession really starting to hit an unemployment rate at 5% for that to be possible.
But you do think that high 5s, low 6s, kind of teetering between that is a realistic kind of range for the rate to the consumer in 2026?
Yeah, I think a 5 handle, I would say I'm pretty confident and kind of that riding that line between 5s and 6s, very confident.
All right. Well, hey, I'll take that answer. I mean, that's better than we've had in the last 3 years. I think it's good. All right, Jason. Well, we could go on all day, and like I said, it's my goal to have you back on market shares. I mean, this is a segment that I think is important to loan officers to learn about. There's lots of places where you can get information about what's going on in the market daily, but a conversation with a guy like you who lives in this every day, where we can go really deep into the things that are directly impacting loan officers and the products that they sell and so on and so forth. So I'll be giving some additional thought to some things that we can discuss in the future with our audience here at Market Shares. I appreciate you coming on today and getting out of your comfort zone and willing to come on here and let me just, I didn't script Jason on what we were going to talk about. I talked to him about 2 minutes before we got on here, and I said, I'm going to hammer you with all this stuff. And he said, bring it on. So anyway, it's very fun. And if you enjoy this kind of content, let us know in the comments. I want to know if people like geeking out on this stuff as much as I do. Jason, since we are just a day before Thanksgiving, I will say happy Thanksgiving to you. To our audience, it's already past Thanksgiving, so I hope you had a really good turkey. I'm going to have a prime rib for Thanksgiving, so I'm sure that will be fantastic. And until next time, you guys, I appreciate you tuning in to Market Shares. Look, we really want to grow this channel in 2026, and I promise you in 2025, we'd have some really cool episodes and some great guests, and we delivered on that. So let people know about Market Shares. Subscribe if you haven't already. I got to get that number up over 1,000 subscribers, but more than that, you need to tell your friends in the mortgage industry about what we're doing over here, and you can expect to see more from Jason in the future. Until next time, take care.